Hi everyone, my name is Jade, and in this month's What's Going On in the Real Estate Market in Southeast Wisconsin, we're going to cover the usual recession watch. We're also going to look at the market forces affecting prices in our area. And we're going to look at the fundamentals that's causing some of our inventory issues. And then we're going to break down what's really going on in the real estate market in our area. So let's dive in. All right, so this is a side-by-side comparison that I like to do that breaks down what happened in 2008 with the housing market crisis and the recession and how that is dramatically different from what is going on right now. First and foremost, back then we had a buyer's market. We had hypersupply. We had overbuilding. We have an overbuilt number of homes, so more units were available. And then also because of subprime lending, which was super not fun, we had an abundance of foreclosures hitting the market. Those two forces combined, what happens when supply goes up? Price comes down. So that was one of the main drivers for that dramatic bubble, that burst, and that plummeting prices, the subprime lending. And then nationwide, we had record low levels of equity because that's when everybody was buying up the market in a bubble, which was causing a lot of delinquent mortgages. And then we also had plummeting interest rates at that time. Now, it is a seller's market. Still, people, there is no inventory in our area. If you find some or have any, call me. We can talk. So there's very little inventory right now. What happens when supply goes down? Prices go up or they are stable. And right now, that's what we're seeing in our area. We're seeing stable prices. We also have very strict lending standards today, which is really good because now we have a healthy, if not albeit starving, mortgage industry. We also have historic highs in equity, which I'll show you the graph for that. We have historic lows in delinquencies and foreclosures. I also have a graph for that too. Inflation is high, and we have high and continuously rising interest rates. Hopefully this is the last one from the feds. We'll see. That's what they're signaling, but we'll see. I have been saying for a while now that we in Southeast Wisconsin are not in a housing recession. Why? Because depending on your trade area, depending on where you are at in the region, what's going on in your local economy, you are in different phases of the real estate cycle, going from the recession to recovery to expansion to hypersupply back to recession. 4 phases that repeat over a 20-year cycle depending on where you're at. Parts of California, parts of Texas, such as Austin, they overbuilt. They went into their hypersupply stage. They also overappreciated, so now prices are coming down, and they're starting to feel those price drops that are associated with a recession. Home price growth between 2020 and 22 versus home price growth between 2022 of July to February of 2023. So there are areas that are still booming, such as Miami, Florida, Knoxville, Tennessee. There's Austin, there's Dallas. They experience that high growth. Now they're being followed by a declining housing prices. California, they have weak relative national average, whereas areas like Chicago and Philadelphia, they have steady growth, as do we. This is a very important indicator because the rental market affects the real estate market in a huge way. What do you think what happens when rental prices get so high that it now becomes more affordable to buy a home and mortgage a property over 30 years? Well, then you have an exodus out of the rental market and into the home buying demand, which pushes up prices. When the rental market decreases, then you have an exodus out of the home buyer market now into the rental market. And this decrease isn't bad. We just saw a huge influx over the 2021-22 period into the rental market, and now it's coming back down to normal, healthy numbers. The problem we have right now, though, is what's keeping our market strong is the fact that we have so little inventory. But because of interest rates, we've had less buyer demand, less investor demand. If it becomes more palpable, making more financial sense for these buyers that are in the market to just give up for now, save money and go into the renting market, we actually might start seeing softening in home prices because of the lessening demand from the high interest rates and the affordability of renting. This is a graph from Realtor.com. It shows how the rental market prices in the Midwest are surging. And this is a picture-perfect example of how real estate differs from region to region. So previously, I showed you a national graph where the rental prices were dropping. In this graph, though, it shows that in the Midwest, where we are, rental prices are holding strong. So it's completely opposite to what the national average is. So right now, it's just as unaffordable to buy, and also it's just as expensive to rent. So right now, we don't have an exodus in or out either market because both are pretty high. So this is also good for the housing price market, because if it costs just as much to buy a home than to rent, then why don't we buy instead of giving our monthly payments to some landlord? So this is what's going on in our particular region in terms of rental prices. This is a side-by-side graph of the months of inventory in Walworth County of single-family homes. So what is months of inventory? If no new homes came on the market today, how long would it take for the current demand to absorb all of the inventory? Now, if we have less than 4 months, we are in a seller's market. 4 to 6, we're more in a neutral market. Above 6, we are in a buyer's market. So as you can see, last month and this month, we are still in a seller's market. Last month, we were at 1.19. This month, we're at 2.18. And it's rising. So there's no need to be alarmed. We're not heading out of the seller's market anytime soon. What do you think is causing this? Well, it could be an increase in supply, which I highly doubt. It also could be a decrease in demand, which I'll show you is not the case, or it could be a little bit of both. Not to mention interest rates. We had the fastest interest rate hike that we've seen in almost 30 years, and that interest rate hike is squeezing builders and developers and making it very difficult for them to turn a profit. A lot of them are just sitting out the market right now, waiting for that to stabilize so that they don't find themselves in trouble, especially with acquisition and development loans, them being floating interest rates now. So right now is not a good and stable time for a lot of these builders. This graph, this table shows the declining building permits in southeast Wisconsin. It compares January through March of 2022 to that of 2023. Walworth County down 24.2%. Kenosha 23.8%. Racine, they are up 48.9%. I'm not sure what's going on there, but you go, Racine. Get your build on. If it takes a builder approximately 12 months, if they start right now, to build a home, we won't expect to see any new supply come on the market till at least the summer of 2024. That's assuming that there's no labor or supply or material availability issues causing any more further delays. To drive my point home about why we're not in a recession here in southeast Wisconsin, this is from the WRA, the Wisconsin Realtor Association, that did a study of the median home prices comparing March of last year to March of this year. As you can see, Kenosha County, they're up 4.4%. Racine County up 6.6%, Walworth County up 5.2%. So home prices are still appreciating, meaning we're not in a housing recession in our area. We will be at some point, but not yet, and probably at least not until next summer if home buildings come online. Now, if there is an exodus of demand, that might be a different story, but time will tell. This graph of the U.S. properties with foreclosure filings shows the health of the mortgage industry. And remember how I said we had very strict lending standards? As a result, you can see we are at historic record low levels of foreclosure filings. In fact, this graph from Adam, they just did an update in April, and based on the foreclosure filings, which includes default notices, scheduled auctions, and bank repossessions, we're down 10% from last month. We are up 8% from last year, but we're down 10%, and we're still at record lows. So we're going to want to watch this, but if you are waiting for the bottom to drop out anytime soon and a fire sale to happen so you can snap up a bunch of real estate, you're not going to find that. Don't hold your breath. Remember how I said that we were at historic highs in terms of equity nationwide? This graph from Adam again, it shows the sales last year of sellers who sold their homes that had home prices in and around the median home sale prices in their area. The average seller last year realized a $100,000 gain in their equity. So a 60% return on equity, or $100,000. That was the average equity realized from sellers who sold their home last year, who didn't have high-end luxury homes, but normal median priced homes. So what does this mean in terms of supply for our region? We won't see any new influxes in supply come online from new homes at least until the summer of next year, hopefully, unless interest rates drop dramatically, maybe to around 4%. Don't expect to see sellers start to pop in the market eager to sell their home and relocate or pick up where they left off with their life plans. For buyers, if it is a well-maintained, well-priced home, expect to compete against multiple offers. I had a buyer quite shocked just recently when they knew that there were multiple offers on the home that they were making an offer on, and they received a multiple counteroffer proposal, and they didn't expect this to happen. And that's what happens when you have a well-priced, decently maintained home. That's going to continue as well. If you're waiting for that fire sale, don't hold your breath. Now, for sellers, we are still in a housing shortage. So while it's not as lucrative as 2020, 21, or the early start of 2022, it's still a good time to sell your home. If something happens in terms of recession, I need to eat my foot, and we do have a housing recession. The good news is that the majority of homeowners have, again, that historic high equity. So they're going to be able to ride it out and just wait it out. We're not going to see a lot of foreclosures hit the market, which is why I say don't hold your breath even when there is a recession. All right, remember when we were looking at the months of inventory, I said that was going up, and it could be because there is waning demand. As you can see from these two graphs, that's not the case. Last month, we had about 51 days on market. This month, we have 39. So the amount of time a home sits on the market is decreasing. Demand is not yet wavering, even as interest rates are rising, which is actually a very good sign about the health of the real estate market. The interest rates, even though they have scared many people out of the market, there is still strong demand for homes in our area. This is a key indicator for sellers. This is the big one for them. This is the sales to original list price ratio. So what does this mean? If you listed your home for $100,000 and then sold it for $105,000, your sales to original list price ratio would be above 100%. If you sold it for less than $100,000, your sales to original list price ratio would obviously be less. Last month, we were at 95.9% on average. This month, 101%. So that number is slowly rising. And this is happening because, as you saw, we have a very low inventory still, but we have steady rising demand. So that demand, that increase in demand is pushing the sales to original list price up. So again, sellers, this is a really good time for you. What does this mean for you? If you are looking to sell your home, if you have a well-maintained home, work with your realtor to price it properly. If you do, you can expect to have multiple showings and likely multiple offers, and that's actually going to drive your sale price up. Buyers, work with your realtor. Make a fair market value offer. Be amenable to covering, say, the low ticket items, and that's going to make your offer more attractive, especially if you have any contingencies like a home inspection contingency. And show them you're not going to sweat the small stuff during that transaction time period. And also, don't make lowball offers, especially in this market. You're just going to waste your time, the seller's time, our time. They're just going to reject it, pass you up, and wait for someone else to come in and make a fair value offer. This is not the market for lowball offers at all. All right, we've covered a lot of content. If you have any questions, there's my email. Feel free to reach out. I love getting questions, or go to our website, click contact us, and send me a message. You could also send us a message on Facebook as well. I post all of these there as well as on YouTube. Definitely subscribe to our channel. Until next time, thanks for stopping by.